Hi, everyone. Thank you for joining us today. My name is Nathan Sadowski, Wealth Manager at Pacific Excel. Today, we're going to go over the market recap as well as what we see moving forward. This is brought to you by your investment management team at AssetMark, as well as research team. In addition to market recap, we're also going to talk about inflation, where we're at now, as well as where the economy is on a snapshot, where we're sitting, and how does the current Fed rate environment look with the rate cuts, and what's that going to do to the markets? Okay, let's take our eyes up to the top here. On the left-hand side, you can see year-to-date S&P 500 is up over 22%. Very good sign. A lot of that was led by our tech sector. If we take our eyes down to the bottom, it's going to be in the orange bar, a little bit over 30%. So everyone who received their QPRs or quarterly performance reports have been very happy. So that was on the equity side, small cap, emerging markets, developed markets, even U.S. real estate was in the positive year to date. We take our eyes to the right-hand side, we can see there's this bar in orange, and it says gold, just a little bit here to the right, and it's up even higher than the S&P. It's up a little bit over 27%. So gold has did a lot of climbing this year in 2024. Other commodities, high yield bonds, U.S. bonds have been doing fairly well year to date as well. It's good to see some growth in the bond industry. Also, if you take your eyes to the right, so a standard global, what they call a 60-40 portfolio, 60% stock, 40% bonds, moderate risk, that's up a little bit over 12% year to date. So most of us should be pretty happy. Okay, let's talk about inflation. If we take our eyes to the left, rewind a couple years ago back, August 31st, 2022, inflation was a little bit over 8%. Food cost, energy costs, even other areas, costs were pretty high. We also remember what happened to the market. Market had a major drop over 20% that year as well in 2022. Rewind 1 year back in the middle bar here to August 31st, 2023, inflation went from 8 all the way down to 3.7, which was nice to see. We still had some room to climb, and in that case, interest rates were still rising from the Federal Reserve and Jerome Powell. Now 2024, late August, that inflation has come down to 2.5, getting closer to that 2% target rate for the Federal Reserve. So these are nice to see. Scorecard, as we can see on the left-hand side, growth is still there. Jobs are starting to slow down, but it's all not too bad. And consumers like you and I, we're still eating, going out to restaurants, we're traveling, doing everything we need to be doing to be living. And business cycle is still intact, which is nice to see. Manufacturing for new products is slowing down, but the servicing is still doing okay. And we take ourselves to shelter on the second indicator here with inflation. Slowdown is starting to catch up. Gas, that peaked back in April 2024, starting to come down a little bit. And healthcare, that's always rising. That's very hard to talk about right there. So the COVID era with distortions, in the supply chains, a lot of that stuff has already cleared up, which is nice. Fast forward, 4+ years. On the last indicator here is the financial conditions. Rates are coming down. They had their first rate cut back in September. Credit spreads are also rising. And equity volatility, it's been up and down. We also have election coming up here, less than 2 weeks. So, but overall, snapshot of the economy is doing good. So history is a guide to why these things are important, especially with the Fed cuts. We take our eyes all the way to the left here on back to the late 70s, early 80s. Interest rates were 18, 19, 20%. We've been this slow trend downward, for the last 40 years. We had 01, we had the tech bubble. Feds dropped the rates right down to single digits. 1%, 2%. Then they started rising back up. And then 07, we had another drop with the housing crisis. And they kept that flat right down, 0, 1%, all the way through about 2016. It was up on the rise. 2020 happened, pandemic. Fed cut the rates down again to increase spending, and that was flat up until 2022. 2022, inflation was high. Feds raised interest rates, up to about 5.25%. And then this last month, they just dropped them. So we're now in a decreasing Fed rate environment. Some takeaways. Economy is slowing. It's not stalling. And slower growth and inflation have historically been good for equities and bonds. But it can be a little bit bumpy, but we're in good shape. And for those investors, we want to make sure we stay disciplined and stick to your short and long-term goals. Appreciate it. Thank you so much for watching. See you soon.